Hello, my name is Andy Paniuk, and I am the president of Money Concept Sunbury. And today we have Ben Paul, the president of Liberty One Investment Management, with us today to talk about a very interesting topic, fees. But he's going to do it in a unique way. Um, he is going to discuss a concept that I wasn't really aware of for many years, and that is a mutual fund tax trap. So, Ben, can you tell us? It's kind of a tricky name. Can you tell us what a mutual fund tax trap is?
Yeah, I sure can, Andy. And it's actually one of my favorite concepts to talk about because it gives clients and prospects kind of that light bulb moment. It's kind of that aha moment where they say something along the lines of, why hasn't my other financial advisor told me about this? Or why haven't I heard about this before? Because it's such a simple concept when you see it, but it's not something that's generally top of mind. So I love highlighting this in various forms. And what I'm going to do here is I'm going to share a piece with you. Let me share my screen. Okay, so the mutual fund tax trap. So there's a saying in investing, it's not what you make, it's what you keep that matters. And in the investing world, there's a lot of things that can erode a return, work against you. One of those things is certainly taxes. Taxes, of course, is what Uncle Sam takes out of your pocket after you make some money. And that can come often in the times of income tax, or in this case, capital gain tax. So for those who don't know, capital gain tax is when you invest something, let's say you invest $100, it grows to 150 and you sell it. Well, that $50 gain, that's referred to as your capital gain. And you'll pay tax on that gain when you sell that position, when you actually realize and recognize that gain as yours. If you don't sell, you're not realizing the gains. You have to sell, realize the gain, and you'll pay the tax. Now, mutual funds are something that almost everyone has invested in some way, shape, or form. Usually in a 401k, 403b, retirement plan, maybe Roth IRA, traditional IRA, etc. So first and foremost, I definitely want the audience to understand that this concept does not apply to your retirement money. So this is not for your tax sheltered money. Think about this concept as it applies to your non-IRA accounts, your non-retirement accounts. Because your retirement accounts, they're already tax sheltered. So what we're going to talk about won't apply to that because those are sheltered. But for your non-IRA accounts, you sell a house, sell a business, inherit some after-tax money. You've been accumulating some after-tax money in an account separate from your IRAs. That's what this concept is geared towards. Now, zooming in here, just so I can explain the graphic, is think of a mutual fund as a big basket of stocks. That mutual fund is often going to own dozens, sometimes even hundreds of underlying holdings inside the fund. Now, there's a mutual fund manager that oversees those holdings. And that manager is going to buy and sell the underlying positions. And every time that buying and selling happens, it's referred to as turnover. So the manager is turning over his or her inventory of underlying investments inside that fund. Now, if what is being sold is sold at a gain, that triggers a capital gain tax that gets passed through to the shareholder of the fund, to the investor. And the downside to that is, even if you're not selling a single share yourself, even if you don't need the money, even if you're not liquidating a share of the fund, that tax is still passing through to you because the underlying holdings are being sold, even if you're not selling any of your shares. And stick with me on this. Not only that, but when that gain is paid, you're paying your share of the gain based on when the fund bought that holding, not based on when you got into the fund. So for example, it's an extreme example, but it helps me just talk about the point. Let's say that you bought Amazon stock, or I beg your pardon. Let's say that the fund bought Amazon stock at $300 per share, and it goes up to $3,000 per share. But let's say you got in at $2,900 into this fund, and the fund manager decides to sell some Amazon. Well, you were only in there for $100 a gain, but you're going to pay your share on all the gain from 300 to 3,000, because it's not about when you buy into the fund. It's about when the fund bought those underlying positions, and when they're sold, the gain that's realized is distributed to all the underlying share owners of the fund. Now, here's what it looks like, mathematical form. Let's say that you had a $100,000 investment. This is just to understand the math. $100,000 investment in a fund that turns over 37% of the underlying holdings, and on average at about a 39% gain, and let's assume a 15% tax rate. Well, that's over $2,100 in tax. On a $100,000 account, that's 2.1% tax expense just to own the fund, even if you're not selling any underlying shares. And here we are filming this May 2022. Market is struggling this year. People are selling. That turnover is being triggered inside so many mutual funds, even as we speak. So far this year, I guarantee you, clients are losing money in their funds, and they're going to pay taxes to do it because the holdings are being liquidated at gains, positions are being unwound, those capital gain distributions are going to pass through. So this is a very, very hot topic right now with everything going on in the market. And the more people that talk about it, the more people that understand it, the better, because it's definitely a very inefficient vehicle to own for taxable money, especially these days with so much volatility unfolding. So that was a long-winded answer to your question, Andy, but that's the crux of what the mutual fund tax trap is all about.
That just makes my head swim, Ben. I'm looking at that and I'm thinking, I remember 2008 when there was even a worse downturn in the market, but today we're really kind of experiencing that right now, where people are leaving the market. They're selling their positions because of fear or whatever, and that causes the mutual fund managers to liquidate even otherwise stocks or positions that they wouldn't necessarily under normal market conditions.
Right.
And then in turn it kind of snowballs to these fees that come to us in taxes, or our clients in taxes at the end of the year.
Right.
So it kind of seems kind of to be like a penalty for those who stay.
It is, and it's kind of the ultimate irony. And there's another layer to that penalty that you speak of, and the irony is most of the people who are selling are in 401ks or not in IRAs, and we all know the folks at work that are looking at their 401k every day and trying to day trade and move money around. Well, when those folks hit the panic button and liquidate from their 401k, just go to cash for a little while, there's no taxes for them because they're in a 401k plan. They just liquidate it. But that liquidation gets passed on to all the shareholders to have to absorb. And so there's the tax sheltered people hitting sell, passing on capital gain to the taxable money that has to pay the consequences, and they're not even the ones selling. So you're right. You almost get penalized for doing the right thing and holding it, And the ones who are selling, especially in qualified money, there's no tax consequences for them whatsoever. So really the solution is go straight to the individual equity. Own your own shares in your own name, in your own account. Don't be at the mercy of a mutual fund manager. Don't be at the mercy of someone else's cost basis and built up capital gain exposure. Own your own shares in your own name, in your own account, most importantly, with your own cost basis. That's a great way, fantastic way, really, to reduce this overall tax drag on your taxable assets, your non-qualified assets.
Well, that's a great point, Ben. I'm glad you brought that up, which is covered in another video that we have called double compounding, right? Isn't
Yes.
that the name of it? Yeah.
Yes.
So that video, double compounding, goes and explains the benefit of how that works, and turns out that can even be kind of a safe haven against these mutual fund tax traps.
Yes. Yeah. At Liberty One, we have a saying, we like to manage with precision, right? So going straight to the individual equity, straight to the stock, the actual holding, allows us to manage the tax implications with precision. But also, to your point, Andy, about our other video, double compounding, we can also manage the income power with precision. So there's a lot of benefits to going straight to the individual stock, straight to the holding itself. There's a high degree of control that the manager ends up having. Don't go broad, go narrow. Be really precise in what you own and why you own it.
Well, that's a great point, Ben. And yeah, and that puts the control in the hands of the client and the advisor,
right,
when it comes to fees and things of that nature, which many people are that's a conversation we have often is fees. This is a great illustration here of how you can be paying over fees with not even realizing.
Right. Exactly.
Well, Ben, thank you again for explaining this to us. I think it's absolutely fascinating, and I think people need to know it. Again, my name is Andy Paniuk. I am the president of Money Concepts Sunbury, part of the Tailwind network of Money Concepts advisors. Ben Paul is the president of Liberty One Investment Management, and one of our premier money management firms that we utilize here in our office. Ben, thanks again, and have a great day.
Thanks, Andy. You as well. Take care.